It's on everybody's mind. Everyone sees it. Up, up, and away we go. Everything's back to normal. Holy moly. This was just about a 3 sigma move here, reporting after earnings. Absolutely insane. Up 27% since the time I pulled it, with an expected move at around like 4 to 5%. So huge move over there, helping out in the after hours, the Qs, the SPY. However, there is still some dark clouds on the horizon, and that's what we need to talk about on today's stock market brief. Why? Well, because we cannot just get FOMO, the fear of missing out from big moves. We need to understand the risks that lie ahead, just like from the flip side perspective. When things are getting very bearish, we need to look at the potential risks up ahead of losing out on potential bounces. So we talk about both sides here on this channel. If you're new here, welcome. Make sure to hit that thumbs up. It is greatly appreciated. Let's get into it. We're going to take a look first at ES, the SPOOs. What took place? Well, not much today, right? We saw some more wicked downside, and it came back up to where the middle of the range. We got outside of the range. We came back inside of the range. Look, it's just chop, okay? When you really zoom out, right, and you look at 4,100 to 4,200, give or take a few points there, we're just in an overall range. And if you go and you just look at sentiment and you follow a bunch of people, you're going to see people say, see, the market's crashing here. And then you're going to see bulls go, nope, we're going to the moon. Then the bears come back, and then the bulls come back, and then the bulls come back, and then the bears come back. But where does that end up being? Well, it ends up being right here in the middle of the range, and people just forget, about everything that they said in the past. So where's the risks that lie ahead right now, as we're just in a chop box, right? Obviously, the debt ceiling is something that we've been talking about. We posted a video March 26th. Now, pretty much everyone's bringing up the likelihood of 2011, the similarities that we see, okay? Now, what similarities am I talking about? Well, let's get into that. So just recently, FX Hedge posted this: United States AAA rating, so AAA rating, may be cut by Fitch. What does that mean? Well, that's a downgrade in our credit. And now, when the SPY was up after hours on the whole big old earnings boost right over here, you can see that it did take a little bit of a hit. Now we're bouncing a little bit. Obviously, this is just news. It's speculation, but it's something to be aware of. Why? Well, do you remember 2011? Well, August 6th reported S&P downgraded U.S. credit rating. That was a 6% move to the downside in a single day. And, we bounced back and we chopped around. This is some massive choppy swings. If you think, well, we're in a choppy range now, look at that range right there. And that wasn't even the low. We actually did hit lower there in October and then started to find our way out of that mesola, okay? Now, if you also notice, we actually were falling prior to that, and there was warning signs in that area. We've discussed warning signs, many warning signs from divergences, from an intermarket perspective, but also looking at like credit default swaps. When you take a look here at the 5-year, yeah, it's backed off a little bit, but it's still relatively high. And when you look back at 2011, before all that stuff took place, credit default swaps were kind of giving us a heads up notice of, hey, something's going on here. That's a 5-year. If you look at the 1-year, we're still, we came off the all-time high, but we're still not too far from it. And if you just look back to 2011, where we started seeing that rise there, and then also the great financial crisis, we're completely surpassing that. You also have safety assets like, for example, the dollar is starting to kind of break out here and rise a little bit further. And now where the correlation is actually starting to show up, go figure, right? We talked about that in the prior video. We talked about the dollar correlation to the S&P 500. We talked about Bitcoin's correlation to the Qs, and the correlation is typically negative for the greater part throughout since it's been around. So the chances are when it becomes positive, there's a high likelihood of the correlation to break and go back to negative. So yeah, as the dollar's pumping up higher, now we saw somewhat of a pullback. Is the dollar getting a little frothy here? We'll explain that when we look at the zone sheet at the end of the video. Now, as this is breaking out, right, we're moving up. Gold has been taking a little bit of a backseat. You can see the correlation is still holding true there. Perhaps this correlation breaks where the dollar continues to rise and gold goes up. We'll see. That's a tall glass of warm water. If we continue on, I will call out that, yes, we saw this massive move, and now it could be consolidating. I just wanted draw out the potential of a falling wedge pattern, which is typically bullish, right? So you have expansion, and now all I'm doing is mapping out contraction. Now remember, a lot of people just, they assume, like, okay, I buy the breakout and it goes up or whatever. I like looking at these technical patterns for one thing, because it shows you good risk to reward trades, right? So when things contract, it's typically going to expand, and that could expand to the downside for a rapid hit, could expand to the upside, could also hit a quick downside and then fly back up. So we've seen multiple times where that happened. Here's the last time we saw gold contract and get very tight up here, and then we saw expansion move to here into this range, and then we started to see our rally up. Now we're kind of pulling back, right? Contracting here. Perhaps if the dollar backs off, we start to see gold step back into play. If you take a look at like economic assets, like Dr. Copper, this one took a beating today, down 2.54%. So if this is getting a little long in the tooth here, perhaps we see a little bit of relief in the near future on copper. But just be aware that this thing is pretty rough and could be telling us, hey, like, I'm sniffing out poor economic activity ahead. You can see what's interesting here is when you have a high and a lower high in copper, but S&P 500 puts in a high and a higher high, that right there is a divergence, and you can see we pointed that out, and kind of the S&P 500 came in a little bit. That's one of those divergences from an intramarket perspective I recently talked about. Now, we look at the daily time frame. This is the SPY. The spider, right? The S&P 500. And yes, we got this yearly high, and we're about 3 trading days separated from the yearly high. Now we got to be a little bit on guard, because what? We are now below the quarter to date anchored VWAP. So I want to be bullish when I'm above it. I want to be more bearish and cautious when we're below it. The last time we were below it was right here, and we spent one day there, and then all of a sudden we had a monster rally. And as we've already discussed, we're seeing some things like, well, right here, take a huge move to the upside that could very well help the market get its feet and potentially bring us back up, okay? Overall, though, if you take a look here, that's the year-to-date anchored VWAP, and we're still floating above that. Overall, just trading sideways. So it's a time to be obviously cautious, but like I said, from a bullish perspective, if we get back above the quarter-to-date, you do not want to miss a move that comes back up to test this yearly high or potentially fills this gap over here too as well. You don't want to miss a move like that just because you're overly bearish, and then you're like just kind of drowned out the noise. You're like, oh no, it's going to fall back down. Who cares if it falls back down? But do you really want to miss that type of move? Well, how do you not miss that move? Well, if we get back above the quarter-to-date, bullish. If we get back below it, be more cautious again. All right, it's really that simple, as price is right there. So you might be flipping through positions here really quick, in and out, but that is what I would be paying attention to. You can see here back month volatility versus front month volatility. You got the VXV over VIX. That's the yellow line. The brown is actually just the VIX alone. So the VIX spiked. This came in. When this reaches up to around 20% above, that means back month is 20% above the front month. It typically tells us that we're around some sort of a topping area, or the price is going to consolidate, or whatever the case is. We were here, right? We backed off. We were here, right? That was a bear market top right here. So it worked really well in 2022, and now it's working again. You can see we came up, and we've just been kind of pounding sideways there. If we take a look at the yields, 58 basis points inverted on the 10s and 2s, 164 basis points inverted on the 10-year and 3-month. Yields have been kind of rising here. I mean, it's not a great look, right? From a macro or economic standpoint, right? This is the best predictor of a recession. So what's that recession going to look like? I don't know when it's going to be. I don't know how it's going to come, but I tell you this stuff now because, like I say, and I'll say it time and time again, it all looks very obvious in hindsight. So when something bad happens, you'll look back and you'll be like, oh yeah, that was very obvious, but I didn't know really what to do or how to trade it or whatever the case is. It's all about managing risk. It's not about thinking about how much reward I can get from shorting the market, because if you think that way and you were short right here, hopefully, unfortunately, you had a very small position, but an options like straddle or whatever type of play to mitigate risk. But that right there can blow people up, okay? That is a blow up type of move on this equity. Now, if we continue on, we're talking about the inverted yield curves. It made me remind me about this chart once again, talking about contraction, talking about expansion. Well, you have the 10-year 2-year yield curve, right? We get inverted, we got inverted right here, and then we're deeply inverted here. And what you'll notice is as the Fed funds rate, right, we're lifting rates here. We're going to hold them higher for longer, potentially. We'll talk about that. But you can see when we uninvert the yield curve, that's when when we've seen market, fall apart. In 2000, we saw it uninvert here, and the market fell apart in 2008. Well, we saw it right here too. It inverted very short period and then uninverted, and well, the market came off, it went up, but then it came right back off significantly. And then you can see right here, when are we going to uninvert? It's not going to be down here forever. That's not going to be the case. All right. The Fed, we're talking about the Fed rate hiking cycle. We're thinking it's coming to an end, right? We're thinking we're coming to a pause, and then we're eventually going to back off. But there was some interesting stuff that took place, right? There's a 66% probability that we're going to hold it on the June meeting. However, the likelihood of raising rates is growing, right? 1 month ago it was at 24.7%. Then it was 28% 1 week ago. 1 day ago, it was 28%, and now it's 33%. So what is that telling me? It's telling me as time progresses, the likelihood of a rate hike is actually increasing. Still, coin toss as it stands right now. However, if you do look at the meeting probabilities and you take out to July, well, now there's a 46% probability that we are going to be getting a rate hike then. So now things are changing a little bit as the market's kind of all over the place. So we'll see here as this progresses and what takes place in the June meeting. And then obviously in more towards the back of the year, we have one rate cut, which it was like multiple rate cuts. So, I don't know. It's a very interesting thing. I remember when the Fed talked last, they said, our base case does not match what the market is currently saying. Maybe perhaps they're forecasting something different. And he said he didn't want to really change the market's opinion, but they need to obviously stand their ground and follow their base case. And with their base case was holding rates higher for longer. And then obviously getting inflation down to their target of 2%. Now, what took place today in the markets? We talked about the 15-minute chart, how to watch for a positive divergence to form. You can see we broke down through the weekly, okay, the weekly expected move, and then we broke down through the daily expected move, and then we finally started to see that positive divergence form, and then we saw a little move up. It backed off, right, using this as kind of a flip. Then it wasn't towards later in the day where we saw a little bit of a squeeze back up to where the weekly expected move, and that's holding as a level of resistance. So you want to see price get back above this to feel a little bit more confident there. I mean, we have a couple more trading days left. 68% of the time, the S&P 500 closes within its weekly expected move. So we'll see here if this is going to be one of those times where we close back within it. Actually, to be honest, if you look back in the S&P 500 or the SPX, it's more like 75-80% of the time it actually closes within there. But we say 68% of the time because why? Standard deviation. Okay, let's take a look at the new daily expected move. The one thing I want to call out, actually, now I'm going to overlay the 5-day moving average, week to date, and the month to date anchored VWAP. As price was squeezing back up, look where it rejected from. It rejected perfectly from the month to date anchored VWAP, okay? The volume weighted average price. So what you want to see is obviously get back above the 412.20, and then you want to reclaim the month-to-date anchored volume-weighted price. So if we do get through these areas tomorrow, understand where we are in context. We'd still be below a 5-day moving average and a steeply declining week-to-date anchored VWAP there too as well. So if we gap up or we open unchanged, right, we'll see how, what takes place. It looks like we can gap up come tomorrow. We'll see if that just takes us back above this, and then we start moving for it, and then it can kind of find its potential rejection up into this area where we have a declining week to date, and then we have the 414.68 as the upper daily expected move, and then we have the declining 5-day moving average. So there's a lot of work that needs to be done here. Obviously, something that can get us way through this would be some very good news, right? And the market just perceives that and they gap us way up, and then we just rip and have a crazy trend day similar to stuff that we saw like this. That was just mind-boggling, okay? However, right, we're still below this key level. 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 So if you are going long, what does that mean? It means you need to be more aggressive on an intraday basis because chances are you'll see more whips and more, more rejections, or potentially even more false breakouts. As far as the daily expected move goes to the lower end, we're 408.45. If we come back down to that range, I will say, so 408, back down into this range, if it was to pull back in there, I'm looking at the RSI. I think the RSI would be actually form a new positive divergence, and that right there could be potentially an area to start to look long or play a U-turn and buy right back up through it. And that could be a potential play coming into Friday, and Fridays have been known as VIX Crush Fridays. So if that is the case, it could potentially create an opportunity to play a little bit of a long trade, or add into a portfolio. If you're already long and you're really bullish, it might be a good place to add. Just kind of thoughts that I have. And you can see the VIX is actually at its higher end of its range. You can see the high is at 1993, and we closed today at 20.03. So it's above that, basically saying the upside's limited. Now, when you apply the zones to the VIX, it's not always 100% obviously accurate on anything, right? There's no holy grail indicator, and these are dynamic and they're constantly changing. But I just wanted to call that out. Last time we talked about the zones, we talked about the dollar and the S&P 500 both being colored red, which means that they were at the higher end. The close was near the high end of that zone. And that, we said, does not happen frequently. But the last time it happened was right here on February 3rd. Or where was it? Somewhere right over here. I can't remember. I'd have to pull back up that episode. But it was basically when I pulled up the chart, it was at a high peak. And that's when we talked about those correlations, like something's going to give. Either the dollar's going to come off, S&P 500 is going to continue, or the dollar's going to move higher and the S&P 500 is going to break down. Well, you can see here, we came back into the gray. So this is now towards the lower end, right? It's saying basically I have 0.8% downside. So we'll just say 1% to 3% upside within its total range here. And then if you take a look at the dollar's saying I have about 1% upside to around 2% to the downside. Okay, so this isn't the place where I'd be like, okay, yeah, now I'm going to go short the S&P 500. You need to be a little bit more tactical than that. I mean, you don't need to be. I plan to be more tactical than that. And then when I look at the other products, when I take a quick glance, a lot of green is starting to show up on the screen. So for example, something like YM, which is we'll just say Dow Jones, right? Dow Jones Futures, or the DIA, which is the Dow Jones Diamond. You can see here we're at the lower end, so this has been backing off. And if you do pull up the Dow Jones Industrials, it's pulled back to its 200-day moving average today. So this could be an area where we find a little bit of potential support or relief. That'd be something to watch out for. Then you have stuff like healthcare. Healthcare is down towards the lower end. Materials is to the lower end. Consumer staples is one that I've been practicing so this is the swing trader community, by the way, or my Patreon, and then you get access to the Discord and has all this stuff. I only charge $9 a month, or you just pay annually, one-time thing, $90. It's probably the least inexpensive thing out there in the market, but you get access to a community of traders, which is fun. And then you get some trade ideas. You get my watch list when I update that. I give weekly expected moves, daily expected moves. I give these zones, not just these, but I give a lot more products, and I include a new column there. I'm not going to talk about that today. And then if you like my stock market kind of indicators and stuff, I do permalinks to those for $9, right, a month, which is you go to Starbucks and you buy a cup of coffee and a sandwich and it's $10.50. All right. So this is just to help supplement, and the Patreons that do help me supplement, that help me leave my corporate job. So thank you to all of them for me to be able to actually do that. And it helps out a lot. Where was I going? I totally forgot where I was going with all of this, but that's okay. Oh yeah, now I remember. XLP. So XLP, in the zones, I just now am playing around with a paper portfolio to start playing around with these signals and seeing about creating more of an alert type service for this specific product. And it's something that I'm interested in. And as it stands right now, most of the names, which I'm only trading with in the S&P 100 as it stands right now before I start branching out further, most of them fall within like healthcare and consumer staples as it stands right now. So a lot of those, and the consumer staples, they've been getting hit very, very hard. So we've been seeing this massive move, obviously, to the downside in consumer staples. But knowing that, we track weekly expected moves and so forth, it's not actually far down at all. And I'm pretty impressed so far. So most likely, if the trend holds, I'm going to be removing some of these positions in XLP on green days. But that is something that I'm playing around with. So if you're interested in checking that out or want to know more information, you can always look inside the community or ask me questions if you're in there. That's all I got for you on today's episode, everybody. See you later.